when I build a portfolio, and it's anywhere from 20 positions to 40 positions, I typically look for stocks that are obviously growing fast, that they have, they're addressing a large market, right? So TAM, total addressable market, strong management team, maybe some competitive advantages. And then if the growth does accelerate, they're able to get some multiple expansion. So anyone that's read the book, 100 Baggers from Chris Mayer knows that, he talks about the two things that are going to help you find a 100 bagger is what he calls the twin engines, which is growth and multiple expansion. So I traditionally look for those two same things, which is one reason I got out of a lot of stocks that did well in 2020, because I think you're going to start to see some multiple contraction, and I just think that, for a lot of these tech and cloud stocks that did so well last year that are now trading at 40, 45 times sales, I just think that the fundamentals have to catch up to the valuation, or the valuation is going to come down to the fundamentals. And I don't want to be in the middle of that. So, I've turned over my portfolio quite significantly over the last couple months as I've gotten out of the 2020 winners and tried to reposition my portfolio to what I think are going to be the 2021 winners. So I run a newsletter on Substack. Anyone can subscribe for free. Or then I also have a paid version of it. The people that are paying get my write-ups right away. The people that are on the free subscription get those newsletters 5 days later. And oftentimes those stocks are moving so fast that if you wait 5 days to get in, you've already missed your, the ideal entry point. Because I do put a lot of emphasis on finding stocks at the right time, at the right price. One of the stocks I'm most bullish on right now for 2021 is a company called DermTech. So for anyone that is, been impacted by melanoma in any way, so there's three main forms of cancer, skin cancer. Melanoma is one of them. Melanoma runs in my family. So I've actually lost an uncle recently to melanoma, and I have another uncle who just had serious surgery on his face to remove some melanoma. And what DermTech does is they created this patch that dermatologists rub on a mole, and then they send it to their lab in California for processing. And it's a genomics process. So they are identifying, going down to like the RNA level of your skin, and they're able to detect skin cancer much earlier, faster, and more accurately than the traditional methods of a doctor literally taking out a magnifying glass and looking at your mole. And if they think there's something suspicious, then they'll order a biopsy where they're, basically cutting off a piece of your mole and sending it to the lab to be analyzed. But then you are, in some cases you're left with a scar. It's longer, it's not as accurate. It's about the same price, maybe a little bit cheaper for the biopsy, but like you said, you're losing the accuracy and some other things along with it. But the problem is that there's over 4 million biopsies done every year, and 90% of them come back negative. So 90% of the people that actually got biopsies didn't need to get a biopsy. The doctor was obviously being cautious, but they were wrong. Whereas if you had used this non-invasive patch to rub it on the mole, which then pulls off some of your skin, like it doesn't hurt. We're talking like, literally microscopic pieces of skin, sending it to the lab to be analyzed, then they can get an indication of whether or not there's something to actually be nervous about. So, we're talking a massive, massive total addressable market. The company's also developing other patches and non-invasive solutions for other types of skin cancer, as well as other skin diseases like psoriasis and acne. This company, it's such an early stage company. They came public last year via a SPAC, very undercover. There's only 3 analysts out there that actually cover the company. One analyst just came out the other day and raised his price target from 29 to 49. The stock's trading in the mid 40s right now, which is actually my largest position as of yesterday. I did a write-up on it last week. As I learned about it a couple weeks ago, just got super excited. If anyone knows the stock EXAS, which is Exact Sciences, if you look at the chart, this stock was trading in single digits 5 years ago, and it's now a $150 stock. So this thing's gone up about 20x in 5 years, which is what I think DermTech could do. Because clearly, if you if you can detect skin cancer faster, cheaper, more accurately, and since it's non-invasive, people are not like intimidated to go to the doctor, because like no one wants to get a biopsy, especially if you know there's a 90% chance it's going to come back negative. So, and then that opens the door for, you know, kind of like a DTC product, right, direct to consumer, where they can mail these kits to the consumer. They can put the patch on themselves, put it back in the box, ship it back to California, and you don't even have to have a dermatologist involved. So there's so many elements to this company that I love. And I just think this thing is going to be a monster for the next few years, which is why it's my biggest position. So when I build a portfolio, I mean, the stocks that I'm the most bullish on are typically going to be at the, you know, the larger allocations. But then I also have to be mindful of like, okay, what's the downside? What, you know, what if they miss estimates, or you know, like in the case of DermTech, you know, the big catalyst that they just got through was, so Medicare is now going to do full reimbursement on the test, which costs $750 or $760. So that was a huge win. And then the National Cancer Association, or it's NCCN, I think it's the National Comprehensive Cancer Network. They just came out with their full gold standard, you know, stamp of approval. So the NCCN is a nonprofit that is backed by the 40 largest cancer institutes in the world. And, you know, they follow the recommendations of the NCCN. And this is like now the more desirable way for dermatologists to, you know, try to detect skin cancer in patients on suspicious moles, or what they call, it's actually called a pigmented lesion instead of a mole. Like that's the scientific term for it. So a PLA is a pigmented lesion assay. Super interesting company. And then, so my other top holdings, so Upstart, I wrote about a few weeks ago in my Substack newsletter. So one of the founder came out of Google, started the company about 8 years ago as what they call P2P, so person-to-person lending. And it really wasn't taking off the way that they wanted to. They were getting ready to run out of money from their investors. So they decided to pivot into what they're doing now, which is an AI-powered underwriting platform. So they developed this AI model with 1,600 data points, and then they essentially license it out or white label it to banks. So banks can now do their personal lending, you know, do that underwriting through Upstart's AI model. So it's, once again, just like DermTech's patch, you know, it's more accurate, it's non-biased, there's way more data points. You know, the traditional FICO score, which is what currently powers most underwriting, you know, processes, is like 12 or 15 different data points on a consumer, or, you know, whoever's applying for that loan. So what Upstart is able to do with AI and machine learning is just way more powerful and accurate. And then on top of that, because it's way more accurate, I guess, I think that's the word I use, but so they're able, so in the 10 or 12 partner banks that they have right now, they're able to approve more than twice as many loans while keeping the default rate at the same, you know, at the same level. So like, so now they can, you know, and by doubling the amount of loans that you're giving out, you're doubling the revenue for the bank, but you're not losing any more money. You're keeping the default rate at, you know, 5%. So that's extremely important. That is a massive revenue generator or driver for these banks. And then, you know, now they'll start onloading additional banks that want to use an AI model for their underwriting, rather than having, you know, two bozos in the basement of the building, you know, looking at all these freaking applications and deciding, you know, who gets approved and who doesn't. Like, why the hell should humans even be involved in that process when you have powerful computers and AI models that can do it instead? And then they're going to take that AI model and use it for auto loans, and then mortgages, and then other types of, you know, the credit world. So, I mean, I think this company is just getting started. I mean, right now the market cap, so when I put it in my newsletter, I think the market cap was around 3 or 4 billion. It's now up to 4.5 billion, because the stock's up about 50% since it went into my newsletter a few weeks ago. But I mean, I think this is the type of company that could easily 10x over the next 5 years. Another stock I loved coming into the year that I wrote about on December 31st in my newsletter was Futu. So Futu is like the Robin Hood of Asia, based in Hong Kong. grew revenues last year at 150%. They'll probably grow revenues this year at 75%. I put it into my newsletter when it was a $40 stock. So that stock is up over 100% since December 31st. So literally 3 weeks, it's up like 120%. It's been an absolute monster. I haven't trimmed it at all, but the thing has moved so damn fast. I really didn't get much of a chance to add to it. So, it was my biggest position the last couple of weeks, but since I haven't had a chance to add to it and I've been adding to all these other stocks, it's kind of dropped down on my list of, top positions, but I still, I like it. I don't love it right now. Anyone listening to this, put it on your watch list, but I'd be cautious about adding to this stock after it's up 120% in a month. That's typically when stocks are ready for a little bit of a pullback. I think Exact Sciences is probably one of the best examples. So Exact Sciences, so the stock's gone up 20x in 5 years. The current market cap is around 24 billion. So if you just do the math, divide that by 20, you're around $1 billion. So 5 years ago, Exact Sciences was around the same size that DermTech is now. So I think in 5 years, DermTech could be a $25 billion company. Maybe in 10 years from now, it's a $50 or $100 billion company, because they have so many other products in the pipeline. It's just hard to know when those products will become available, what sort of approvals they'll get, is there competition coming? Do they get acquired? There's so many questions, but I definitely think DermTech is a 10x, a 10 bagger over the next 3 to 5 years, and then maybe a 100 bagger someday if you go out far enough. They'll do about $6 million this year. 2020. But that was also, a COVID year, the pandemic. A lot of people weren't able to go in and see their dermatologists. The sales reps, they've doubled the size of their sales team. But if the sales team can't go into the dermatology offices and present the product, it's a little bit harder to, build traction. So they've kept hiring people. They've been doing a lot of webinars with these dermatologists and oncologists. So there was clearly some pent up demand. So you saw some of that come through in Q4. So if they process as many patches in 2021 as they did in Q4, they'll double the estimates for this year, because right now the revenue estimates for 2021 are 12 million, up from 6 million last year. So if they process as many patches this year as they did in Q4 annualized, they'll double the estimates for this year. If they process as many patches this year as they did in just December annualized, with no extra growth, just that number annualized over 12 months, they'll triple the estimates for this year. So that's what's going to get this stock moving is, the sales reps getting out to the dermatologist, getting this patch on their radar screen, the dermatologist recommending the patch before the biopsy, and then their facility in California processing, thousands and thousands of these patches every week. So I think, the estimates for this year are way too low at 12 million. My guess is that they come in somewhere between 25 and 30 million. And then it could easily double that or triple that the next year and the next year. So, I think this company gets to $100 million in revenue in the next maybe 2 years, but I expect them to keep growing at least 100, maybe 200% for the next 3 or 4 years.
Yeah. And I was going to say $1 billion valuation on like 12, 20 million of revenue is super high. But if you look at Exact Sciences, it's
you have to look at, so if there's 4 million biopsies every year in the US, and they're obviously not going to convert 100% of those into the patch before the biopsy, but let's just say, they convert a third of them. So, 4 million times a third is, so 1.3 million times 760. So that's $1 billion of revenue right there. So if they converted a third of those biopsies to the patch before a biopsy, and to be honest, it should be 100%. No one should go get a biopsy until they've had the patch done. But that could take 5-10 years to get to that point. But over the next 3 or 4 years, could they get, a third of those biopsies to be patch first And if they do that, then they're at $1 billion in revenue just for this product, not including the other products they have in the pipeline.
Right. No, that's huge. I get that. And I mean, so what else matters is the products they have in the pipeline. So for acne, like what would they do for that?
I'm not sure. So there's not much information on it. They just talk in their investor presentation that they gave a couple months ago. They said that they have partnerships with L'Oreal and Johnson & Johnson to,
Wow. That's great.
Figure out what other sort of genomic testing they can do to diagnose these other diseases and try to come up with the right treatments. So I don't really know, but I mean, obviously those markets could be huge too. They have a board of directors and a scientific advisory board, which is like all industry experts, MDs, PhDs. So, I mean, the company is stocked in terms of like, talent and credibility.
Yeah. Okay, great. So they've had their approvals. They're already pushing out the product. It's a great product and the revenue will grow.
I mean, the big catalyst. So obviously getting the Medicare, Medicaid coverage was big. That happened about 7 or 8 months ago. But the big one was the National Comprehensive Cancer Network. Like that's the game changer. When they come out, they obviously read all the reports, talk to everybody, that they're legit. And when they come out and say, yes, this is our preferred method for dermatologists, that's a big deal. And that's when the stock jumped about 200% on that news. I mean, the stock went from like 10 to 30 on that news. So, but to me, like that put in the floor. Like, so, if, right now the stock's in the mid 40s, that's great. If we got any sort of a pullback below 40, I would just keep on buying like a maniac. So that's the stock I'm probably the most bullish on. That's the stock I think has the most upside over the next 3 to 5 years. Like if we're looking for, 10 baggers, 100 baggers, 500 baggers, you only get a couple of those every decade, right? It's not like, there's 100 baggers everywhere you look. They are hard to find, but if I had to go through my entire portfolio and pick one, that would probably be where I would start first, would be DermTech. I think Mohawk has the potential to be a 10 bagger over the next few years. That's a company that I wrote about a month ago. That stock's up about 100% since, but it's just getting going. They're a consumer products company that uses AI to determine what categories are trending on Amazon and Walmart, through their marketplaces, but where that demand is not being met by suitable products. And then they work with their manufacturers in China to fast track development of a better product and then get it onto Amazon and Walmart within 6 months. Still small. Yeah. The company will probably do at least 400, if not $500 million in revenue this year. So the company's probably trading at under 1.5 times revenue, which is dirt cheap. This stock should probably be trading at 3, 4, 5 times revenue. Because they sell. I don't know the exact percentage, but they do sell a lot of their product on Amazon and Walmart. But then they also have Shopify stores for all of their own products as well. So they don't just rely on Amazon and Walmart. They do direct to consumer as well, which.
So they figure out the most popular products, then they fast track it to a manufacturing product in China, make like a generic version.
So they do a lot looking at reviews. So where demand is picking up in a category, but the reviews on the products that are leading that category suck. And then they can, develop a better product in that category that, that the consumers will appreciate more. Yeah. So if you go to the website, if you go to, I think it's Mohawk, grp.com.
Yeah.
Just check. Yeah. MohawkGP.com. You can see all the different brands they have. It's a pretty, they're not just focused on one vertical. They have everything from, back straps to improve your posture to, mini fridges, that you put in your kitchen, like nice stainless steel mini fridges to high-end coffee makers, all kinds of. So, it is a lot of home appliance, it's a lot of stuff for your home. Yeah. It's a lot of different home appliances and office furniture, stuff like that. But it's really, really nice looking stuff, high quality. And that's the goal. The goal is to introduce a product into a a popular or trending category that where those needs are not being met by the current products on Amazon or Walmart.
Absolutely. So in our last few minutes, I mean, you've given us a lot to chew on. I really appreciate it. I'll definitely look into those stocks. In the last few minutes, just where can people go to learn more from you?
So definitely, I would recommend my Substack newsletter. So if you can go to my Twitter account, which is just my name, Jonah Lupton, and I have the link to my Substack and the link to my stock twits in there. So once a week, sometimes twice a week, depending on if I have the time or if I can find another stock that I'm excited about. But for the most part, I'm doing 4 to 6 stock picks and stock write-ups a month in my newsletter. So, like I said, the last 4 or 5 I've done were Futu, Mohawk. What else did I do? Upstart. I did Stick, STIC, which is good, which is a SPAC that's going to convert to BarkBox in about a month.
Oh, nice.
Super bullish on BarkBox, which is a subscription service for pet food, pet toys, pet treats, and then they're getting into other ancillary businesses like teeth cleaning for your dogs and sorts of that kind of stuff. So those are the first 4 that I've done, and then the last 2 or 3 were Make My Trip, which is the India version of Expedia. So like if you go to the website, like it looks just like Expedia, but it's they're based in India, which has a billion and a half people in India, and you can book all of your air travel, bus travel, train travel, everything, hotels through that site. Make My Trip. The ticker symbol is MMYT. And then I wrote about DermTech, and then I wrote about Band, which is Bandwidth, which is like a smaller version of Twilio. So Twilio is a $60 billion company growing at 35%, trading at 24 times sales. Bandwidth is a $3.5 billion company growing faster than Twilio at 38%, yet only trading at 8 times sales. So, they basically do the same thing. They're CPaaS platforms, communication platforms as a service. Twilio is a better company. Like, I'll give them that. They have more customers. They work with bigger customers. They acquired Segment recently. They acquired SendGrid a couple of years ago. So, like, they're doing a lot more than just, text messaging, voice messaging, etc. But, they're still, like, their core businesses are still very similar. Yet Bandwidth is trading at a huge discount on the multiple. And on top of that, Bandwidth actually owns their own tier 1 network. So they're able to give enterprise customers better pricing, which is why Zoom is one of their biggest customers. Same with Microsoft and Google. And I think if Band's stock price doesn't start moving faster, then someone's going to come in there and just buy them for, 11, 12 times sales, because the company's already profitable. So, and they just acquired a company over in Europe, a CPaaS company over there at, I think, 5 or 6 times sales. Now, the company's only growing at 25%. I get that, but still like a very reasonable acquisition at a good price, versus Twilio just went out and bought Segment for 20 times sales. So I just think Bandwidth, like if you're looking for exposure to the cloud, the cloud industry still, and you want a cloud company that's growing at 38%, yet only trading at 8 times sales, Bandwidth would be a great place to start, versus paying a premium for Twilio or going after like a Fastly or Netflare, Cloudflare, where those stocks are trading at 30, 40, 50 times sales. So
The ticker on Stick was what? STIC?
STIC, which is going to convert to BARK whenever that merger comes through. So the enterprise value was around $1.5 billion. But in terms of multiples and growth rates, I mean, the company's going to grow at 50% a year. And so Chewy, right? Everyone knows Chewy, right? Pet food delivery. Chewy's a $50 billion company right now, trading at the multiple is actually reasonable, but their gross margins are so low because they're just selling other people's products. What BarkBox does, so in the beginning, BarkBox was doing these subscription boxes every month, but they were putting other people's products into those boxes. And then they realized that the margins sucked. So they decided to start making their own products. So now they design and develop and manufacture their own products that go into those boxes. So instead of having gross margins of 25%, now they have gross margins of 60%. and they already have 1 million paying customers every single month.
Great.
So
Wow.
it's
Love
a good business. It's a repeatable business. Customer retention rate is 95%, super sticky. You know, people love their pets. They spend on their pets. You know, at the end of the day, having to go to the pet store every week or every 2 weeks is one more errand that you don't have to worry about now if you're just doing a subscription service. And like I said, I mean, they're getting into these other ancillary businesses like teeth cleaning. And I wouldn't be surprised if we got an announcement soon that they're going to get into like the cat business with, let's just call it like Meow Box, where every month you pay $25 and you get, cat food or cat treats and cat toys and stuff like that. I'm almost surprised they haven't done it yet, since so many people that own dogs also own cats. So I don't know. We'll see.
Make sure to visit silverchartistnation.com for a free weekly chart pack covering early stage assets ready to lift off.
This discussion is for informational purposes only. Nothing in this discussion should be taken as investment advice. Guests are not compensated for their appearance. Do not base any investment decisions on the information presented.